What happens to your money when the banking system breaks? Not if, when. Because right now, in this exact moment, your money isn't actually yours. It's a number on a screen, a promise, an entry in a database owned by someone else. And most people never question that until the day they can't take their money out. I want you to imagine something with me for a second. You wake up on a normal Tuesday. You check your banking app like you always do, and it doesn't load. Not a glitch, not try again later, it just doesn't load. And when you finally get through, on hold for hours, someone tells you withdrawals are temporarily paused. That sentence has happened before. Not in some far-off country, not in some third-world economy you feel disconnected from. It happened in the United States. In 2023, 3 banks collapsed in the span of days. Silicon Valley Bank, Signature Bank, First Republic. Combined, over $500 billion in assets. Gone, almost overnight.
And here's the part that should scare you more than the collapse itself. Most of the people who had money in those banks had no idea it could happen to them. They thought their bank was safe. They thought their money was just sitting there, waiting for them. It wasn't. So today, I want to walk you through exactly what happens when the banking system breaks. Not the theory, not the doom and gloom clickbait version, the actual mechanics. What breaks first, why it breaks, and what people who understood this early did differently. Because there is a pattern here, and once you see it, you cannot unsee it. Let's get into it.
Point 1. Your money was never really there. Here's something most people don't learn until it's too late. When you deposit $100 into a bank, that bank does not put your $100 in a vault with your name on it. It lends most of it out. This is called fractional reserve banking, and it's not a conspiracy theory. It's literally how the system is designed to work. Banks are only required to keep a small fraction of deposits on hand. The rest gets loaned out, invested, leveraged. So when you check your balance and it says $10,000, that number isn't a reflection of $10,000 sitting somewhere physical. It's a liability, a promise the bank is making to you, backed by the assumption that not everyone will ask for their money back at the same time. This is why a bank run is so devastating. It's not that the bank loses the money. It's that the system was never built to survive everyone wanting their money at once. The moment trust breaks, even for a second, the entire foundation shakes. And this is exactly why crypto exists in the first place. Bitcoin was created in 2009, right after the last major banking collapse, specifically because someone looked at this system and said, what if money didn't require you to trust a middleman at all? That's not a marketing slogan. That's the literal reason blockchain technology was built. A ledger that doesn't lie. A ledger nobody can quietly rewrite behind closed doors at 2 a.m. when things go wrong.
Point 2. Confidence is the only thing holding it together. This is the part that really gets me. The banking system doesn't run on gold. It doesn't run on cash reserves. It runs on confidence. Pure, collective, fragile confidence. Think about Silicon Valley Bank for a second. It didn't collapse because it ran out of money overnight. It collapsed because word spread. People talked, group chats lit up, Twitter posts went viral, and within 48 hours, depositors tried to pull out $42 billion. $42 billion in 2 days. No bank on earth, traditional or otherwise, is built to survive that kind of speed. And here's what's wild. The moment people believed the bank might fail, they made it fail. It becomes a self-fulfilling prophecy. Fear doesn't just react to collapse, fear causes it. Now compare that to how a blockchain works. You don't need to trust that other people won't panic. You don't need everyone to remain calm for the system to function. The rules are enforced by code, not by crowd psychology. That's the fundamental difference. One system depends on human emotions staying stable. The other doesn't care what humans feel at all. I'm not saying crypto has no volatility, because obviously it does. You've seen the charts. But the type of failure is completely different. Crypto can be volatile because of speculation.
Banks can be fragile because of trust collapsing at the core. Those are not the same risk.
Point 3. When banks fail, they fail fast, and they fail quietly first. Here's something that should genuinely unsettle you. By the time you hear about a bank being in trouble on the news, insiders have often already moved their money out. This isn't some rare exception. This is basically the pattern every single time. Executives, large institutional clients, people with connections, they get quiet warnings. They shift funds early, calmly, without panic. The general public finds out last, and by the time they do, the doors are already closing behind them. This is one of the most important lessons in all of financial history. Information doesn't move equally. Access doesn't move equally. If you are relying purely on the news to tell you when something is wrong, you are, by definition, going to be one of the last people to know. This is part of why self-custody in crypto became such a big philosophy, not just a technical feature. Not your keys, not your coins isn't just a catchy phrase people repeat online. It's a direct response to watching this exact pattern play out, again and again, decade after decade. When you hold your own crypto wallet, nobody can quietly freeze it while insiders get a head start. There's no closed-door meeting deciding your access before you even know there's a problem. Point 4. Governments step in, but not the way you'd hope. Whenever a bank fails, there's a comforting phrase people repeat. Don't worry, it's FDIC insured. And yes, insurance exists, up to $250,000 per account in the US. That's real, that matters, and it has genuinely protected people. But here's the uncomfortable truth. During the 2023 collapses, the government stepped in and guaranteed deposits above that insured limit too, specifically to stop panic from spreading to other banks. Which sounds reassuring until you realize what it actually means. It means the rules can change in real time based on how scared everyone is getting. The safety net isn't fixed. It bends and stretches depending on the size of the fire. If a small local bank fails, you might just get your $250K and that's it. If a big enough bank fails and the fear is spreading fast enough, suddenly there's a rescue plan. That inconsistency is the entire point. You are not guaranteed protection. You are guaranteed protection if the collapse is politically and economically inconvenient enough to ignore. This is exactly why more people started paying attention to decentralized finance. Not because DeFi is risk-free. It absolutely carries its own risks, smart contract bugs, hacks, human error. But the rules don't change because a panel of officials decided today is a scary day. The protocol does what the code says, every single time for everyone, equally.
Point 5. History doesn't repeat, but it rhymes hard. This isn't the first time. 2008, Lehman Brothers collapses. The entire global financial system nearly seizes up. Nearly 15 years later, 3 more banks fall in a matter of days. And in between those two events, smaller collapses, quiet warnings, ignored again and again. There's a pattern in every single one of these collapses, and it's almost eerily consistent. First, confidence cracks somewhere small, often somewhere people weren't even watching closely. Then, that crack spreads through word of mouth, faster now than ever because of social media. Then, withdrawals spike. Then, the institution can't cover the outflow because the money was never actually sitting there waiting. Then, either a bailout happens or it doesn't, and people lose access to funds they assumed were guaranteed.
Every time, someone insists this time it's different. And every time, the mechanics are almost identical to the last collapse. The only thing that actually changes is the speed at which it happens. And thanks to instant transfers, social media, and 24/7 information flow, that speed is only increasing. This is the actual reason so many people started diversifying into crypto trading and holding digital assets outside the traditional system altogether. Not because it's a trend, not because of hype, because the pattern of banking fragility has repeated so many times that ignoring it starts to feel less like optimism and more like denial.
So let's bring this all together. Your money in a traditional bank is a promise, not a possession. That promise only holds as long as confidence holds, and confidence is emotional, fragile, and contagious. When trust breaks, it doesn't break slowly. It breaks in 48 hours, sometimes less. Insiders often move first, quietly, while everyone else finds out through headlines. And the safety net that's supposed to catch you isn't as fixed and guaranteed as most people assume. This is not a call to panic. It's not banks are evil. And it's not sell everything and buy crypto tomorrow morning. That's not how any of this works. And anyone telling you otherwise is selling you something. What this is a call to actually understand the system you're operating inside of you. Because once you understand how fragile trust-based systems really are, you start to understand why blockchain technology exists in the first place. Not as a replacement for money, as an alternative foundation. One built on verification instead of belief. One where you don't have to hope the person managing your funds tells you the truth in time. The people who navigate financial collapses the best aren't the ones who panic first or ignore it completely. They're the ones who understood the mechanics ahead of time, who diversified early, who asked the uncomfortable question before it became the headline everyone else was reacting to.
So here's the real takeaway. Don't wait for the app to stop loading to start asking questions about where your money actually is and who actually controls it. Understand the system now, while you have the time to think clearly, instead of during the 48 hours when everyone else is panicking at once. If this pulled back the curtain on something you'd never really thought about before, that's exactly why this channel exists. We break down the parts of the financial system nobody explains to you, in plain language, so you're never the last person in the room to understand what's actually happening to your money. Subscribe if you want to stay ahead of these patterns, instead of reacting to them after the fact. And drop a comment. If your bank froze withdrawals tomorrow morning, would you actually know what to do? I'll see you in the next one.